Hello everyone, my first instruction to you is do not watch this video unless you have attempted the entire question paper which we are about to discuss in this video. So this video happens to be the live discussion of the first test paper that I have started in terms of a mock test series on strategic financial management. So if you have already solved the paper, then and then only continue watching this video, and here I won't speak anything further. I'll straight away take you to the questions and we'll begin with the first question over here. So let me expand the screen size for you and we read question number 1A over here. Let us begin. X Limited has invested in a portfolio of short-term equity investments, details of which are given below. Now we have investments A, B, C and D, and we have been informed number of shares, and can you notice market price per share. So how much money you have invested in each of these securities, you can find it out by multiplying the number of shares multiplied by market price per share, and that will give you the amount of money invested in each of these securities. Then you total up the total amount of money invested in your entire portfolio and then find the proportion of money invested in each security, and that proportion of money that you have invested in each individual security will become the weight of that individual security in your portfolio. And then you have been given betas of each individual securities. So beta of individual security multiplied to their respective weights. The weighted average of these betas will give you the beta of portfolio, where the weights will be the proportion of money invested. On the other side, they have given you the expected yield based on the performance of these securities. Maybe the indicator could have been the past performance, and based on that they have drawn the expectation of yield. So with expected yield, again these are basically the returns, or I would say the rate of returns on each individual security. Again we can find the weighted average of these returns, and that will be the return on portfolio. Thereafter we have been informed the market returns and risk-free rate. We could even compute the portfolio beta, and after computing portfolio beta we may simply find out the expected rate of return on your entire portfolio as per capital asset pricing model, and that compared with the expected yield based on the performance of the stock, we can find the portfolio alpha, and that will help you to solve the first part of the question, where the question is asking you calculate the risk of company's short-term investment portfolio relative to that of the market and identify whether the portfolio is favorable. So if you could carefully observe what is the question asking you, you have to calculate the company's short-term investment portfolio in terms of the risk of that portfolio relative to that of market. So which is the risk of the portfolio relative to that of market? It is basically beta. So the question is asking you to calculate portfolio beta, which you can easily compute as weighted average of betas of these individual securities, and how to ascertain the weights, that also I have explained. And then computing portfolio alpha, you will be able to assess whether the portfolio alpha is positive or negative. Accordingly the portfolio will be favorable or unfavorable. Then the next part of the question is asking you whether X Limited should change the composition of portfolio. Now here this could be a tricky thing, so we will have to first deal with the first part and then we will look into how to answer this second part. I'll guide you when we reach the second part. So as far as the first part is concerned, how to present the solution, kindly look into this. I'll not be giving you detailed time to write down the entire solution. What I'll just do is I'll present the solution, give you around 5 to 10 seconds on each slide so that you can copy or you can take a screenshot. And do you know, the column that I am currently dealing, that is amount invested, it is the product of number of shares and market price per share. So how much money has been invested in each individual security has been found as a product of these two columns, and when you take the total of amount invested, it comes to exactly 1 crore. Now the proportion of money that you have invested in each of these individual stocks, that will be A, B, C and D, will be 39 lakhs divided by 1 crore for A, 32 lakhs divided by 1 crore for B, 16 lakh 80,000 divided by 1 crore for C, and 12 lakh 20,000 divided by 1 crore for D. Then we have been given expected yield, and when I multiply the expected yield in percentage to the respective amount invested, I'll be getting the expected returns in monetary value, and when we get this totaled up, we will be getting the total expected returns on the portfolio. So if 18,53,000 is the expected returns by value, by investing rupees 1 crore, we will be getting the return on portfolio by simply dividing 18,53,000 by 1 crore, and to get the answer in percentage we multiply by 100, and this will give you 18.53% as portfolio returns, which could be based on the expected yield. That means the portfolio is capable of generating this kind of yield. So quickly take note of this, and as I told you, taking note of this means take a screenshot, and I'll take you ahead immediately after that. Alright friends, once you have taken the screenshot or once you have finished writing this whole thing, let us move ahead and take up the later part of the solution. So determining portfolio beta will be very simple when you know the weights as well as you also know the beta of each individual security. So you know that beta of portfolio is the weighted average of betas of each individual securities, and here when we are multiplying the weight of each individual security to the respective beta and the aggregate is taken, we will be getting the portfolio beta value, and portfolio beta would come to 1.247. So quickly write it up and then I take you ahead. Alright friends, once you have completed writing this as well, let us move ahead, and now we compute the expected rate of return on portfolio using capital asset pricing model. So you know the CAPM equation, and you just have to consider one thing, that the beta value that you apply over here has to be the portfolio beta, which we have just determined as 1.247, and the return on market as well as the risk-free rate, both were informed in the question. So just substitute the values and you will be finding that the expected rate of return using CAPM comes to 17.976%. So what is the idea now? That if the portfolio has so much of risk, we would have 17.976% as expected return, but the performance based return of the portfolio, which is based on the expected yield informed to you, is little higher than that. So when you compute portfolio alpha, it is RP, that is return on portfolio, minus expected rate of return as per CAPM, and when you find that difference, you definitely get that difference as a positive difference, that is 0.554%. So we will say that portfolio alpha is positive, therefore it can be concluded that the return on portfolio is higher than the rate of return that can be expected on CAPM. So we will conclude definitely that the portfolio is favorable. So please write it up and then I take you ahead. Alright friends, I'm sure you have completed writing this whole thing, and if you now focus on the second part of the question, it is asking you, would you recommend any change in the portfolio? If the question is asking recommendation of any changes in the portfolio, you can assess that only when you identify each individual security, whether to invest in that individual security, is it beneficial or not. And to do that, what you just need to do is determine alpha for each individual security. If the alpha for any security is negative, you should not invest or you should not stay invested in that particular security. You should disinvest, or in other words, you should sell out that security. Your portfolio should include only those individual securities which provide you a positive alpha. So let us look into that part of the solution as well. So in that part of the solution, what you will first do is you will write calculation of expected rate of return using CAPM and alpha for the 4 securities. When you do that for security A, you get the expected rate of return as per CAPM as 15.2%, and the return based on its expected yield is given in the question as 14%. Therefore, the alpha of that security comes to negative 1.2%. Same thing if you do for security B. Look at what you are getting. Here you are getting a positive alpha of 4.1%. So please write up this much and then I take you ahead. Alright friends, I am sure you have completed writing this much. Let us move ahead and look into the later part, that will be determining alpha for security C and D. We again find that security C is resulting into a negative value of alpha, and security D is also resulting into a negative value of alpha. That means we conclude one thing, that securities A, C and D all are giving negative alphas. Only security B is the one with a positive alpha. In such a scenario, how would you recommend a change in the portfolio? So first of all, the fundamental point that you should never ignore is your portfolio should include securities which have positive alpha. The moment you find a negative alpha, your decision should be to sell that security, means your portfolio should exclude that security. Now here what we are finding, the portfolio is comprising of 4 securities A, B, C, D. The alpha of security A, C, D, all 3 are negative. That means you should sell out A, C and D and put all the money in security B. That will make your portfolio alpha equal to the alpha of security B. But do you know what will be a drawback? Drawback will be you are deviating from the portfolio concept, correct? Portfolio creates a position of diversified investment, and when you are putting all your money into a single security, you are actually taking too much risk. You should not forget that. However, because we have no other information of any other securities to be included in the portfolio, as part of the conclusion, you will definitely write that all the monies should be invested in security B only, and do mention a disclaimer, a kind of warning, that doing so it will put the portfolio at risk because the diversification advantages will be foregone. So let me show you how to write up that concluding part over here. In that part, you just write as conclusion, it is observed that investments A, C and D are unfavorable as they have negative alpha. The only favorable investment is investment B. X Limited should divert the entire investment into investment B for optimizing the portfolio. However, doing so, diversification advantages shall be foregone. So please write up this concluding part and then I take you ahead with the next question. Alright friends, once you have written these concluding points, let me tell you this question was carrying 8 marks. There were 2 parts in the question. First part wanted you to compute portfolio beta and portfolio alpha and to conclude whether the portfolio is favorable or unfavorable. You may assume equal marks allocated on each part, that will be 4 and 4. And if you are correct with the first part, you can reward yourself 4 marks. If you are wrong with the second part, definitely that other 4 marks you lose out. You will be getting entire 8 marks only when you are fully correct, and most importantly the conclusion writing also has to go correct. Alright friends, let us move ahead and now take up the next question, that will be question 1b, and question 1b reads like this. Risk-free rate is given as 8%, rate of return on market portfolio is given as 18%, beta is given as 1.2, expected dividend by year end is given as rupees 24 per share, expected share price by year end is given as rupees 390. You are required to determine the equilibrium price and decide whether the share should be purchased, held or sold for the following cases. Case 1, it mentions actual price at present is 340 per share, and case 2 mentions that actual price at present is rupees 350 per share. And the second part of the question says, what conclusion can you draw from the value of alpha in each case? So first of all, the question has two parts, and the marking of the question has been given clearly as 3 plus 3 equals to 6 marks, and that means very clearly for each part of the question you will be rewarded 3 marks on individual basis. Within one part there may not be marks for small steps, so either you get that entire 3 or you get nothing out of that. So be careful about that. I'll show you the answer for the first part now. So before you begin with the first part answer, just let me tell you that you have been given risk-free rate and rate of return on the market portfolio along with the beta of security. Do you agree that this much information is enough for you to determine the rate of return as per CAPM? Once you get the expected rate of return as per CAPM, with that information, when you link the expected dividend and expected share price, you can definitely find the equilibrium price, and comparing that with the quoted market price, you may identify whether the stock is underpriced or overpriced, and accordingly decide whether the stock should be purchased, held or sold. And likewise, when you come to the second part, you have to compare the individual expected rate of return as per CAPM with the potential rate of return for each stock, and you determine the alpha of each stock and accordingly decide whether the stock should be held or purchased or sold in each of the two given cases. So let me show you the answer for the first part first, but the common working will be the expected rate of return as per CAPM. So CAPM equation you should write, define all the variables along with the known values, and when you do that, you will be able to set all the parameters clearly and determine the expected rate of return as per CAPM as 20%. Quickly take note of this and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead, and now we talk about determining the equilibrium price, and P0 equals to D1 plus P1 divided by 1 plus KE, and we can just compute P0 as 24 plus 390 divided by 1 plus 0.20, because the variables that we have used will be D1, which is expected dividend receivable by year end, P1 is the expected market price of the equity share by year end, and KE is the expected rate of return as per CAPM, and P0 is the equilibrium price. So the equilibrium price that we are getting is exactly 345. Please take note of this and then I take you ahead. Many students have questions in their mind that, sir, is it necessary that we write the definition of all the variables every time we write a formula? I would say yes, consider that as a mandate for you, because if you are not writing this, you are giving a scope to the examiner to find an opportunity to deduct your marks. Here, be clear with one thing: if you want to score out, that means you have to present your solution flawless, and a flawless solution will indicate all of these variables defined every time. I'm not going to repeat this instruction again and again, but this is a clear instruction forever. Keep that in your mind, and then let us move ahead and write up the conclusion over here. In terms of the conclusion for case 1, the actual price, that is 340, is less than the equilibrium price. The stock is underpriced in the market, therefore it is advisable to buy this security. When it comes to conclusion for case 2, the actual price, that is 350, is more than the equilibrium price. So we can conclude that the stock is overpriced in the market. Therefore, it is advisable to sell this security. So please write up this as well, and then I take you ahead. Alright friends, once you have completed writing this part, let us move ahead and deal with the next part of the question, where the question has asked you to determine alpha. Now, we know one thing, that alpha of the security will be computed by taking the expected rate of return based on performance of the security minus the expected rate of return as per CAPM. And expected rate of return based on performance of the security can be computed by taking K equals to D1 plus P1 divided by P0 minus 1. So we have to compute KE based on the performance of the stock, which will be the first part of the alpha equation, and the CAPM based returns will be the second part of the alpha equation, and then the difference between the two will be the value of the alpha. So quickly take note of this, and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and compute the alpha for both the cases. So case 1, what you get as the expected rate of return based on the performance of the security, it is 21.76%, but the expected rate of return as per CAPM was only 20%. So when you compute alpha, the alpha is positive. So you can say for case 1, alpha is positive, therefore it is advisable to buy this security. Don't forget, exact same conclusion we have drawn even through the equilibrium price approach. Case 2, when you compute KE, what you are getting as expected rate of return based on the performance of the stock as 18.29%, but the expected rate of return as per CAPM is 20%. So the alpha of the security under case 2 comes to negative. So the conclusion goes this way: alpha is negative, therefore it is advisable to sell this security. So in case 1, you would recommend to buy, in case 2, you would recommend to sell. So please write up this whole thing, and that will be end of the solution. Alright friends, once we have completed writing this much, let us move ahead and take up the next question, that will be question 1C. And this will be again a question of 6 marks, and let us read this question. This question is same as question number 9 in your textbook, which is a question from corporate valuation. So let us first read this question. XN Limited reported a profit of rupees 100.32 lakhs after 34% tax for the financial year 2015-2016. An analysis of the accounts reveals that the income included extraordinary items of rupees 14 lakhs and an extraordinary loss of rupees 5 lakhs. The existing operations, except for extraordinary items, are expected to continue in future. Further, a new product is launched and the expectations are as under: sales, material cost, labor cost and fixed cost given in rupees lakhs. Further informed in the question that the company has 50 lakh equity shares of rupees 10 each and 80,000 9% preference shares of rupees 100 each, with PE ratio being 6 times. You are required to: number 1, compute the value of the business, assume cost of capital to be 12% as after tax, and the second part of the question is asking you determine the market price per equity share. So we have seen similar type of questions earlier in corporate valuation. So how to answer this? Put a focus point over here. You'll make a statement and you get started with the current profit after tax. Mind it, the tax rate given to us was 34%, and can we agree that after subtracting the tax, what profit remains after tax will be 66%, because if 34% is the tax rate, 66% will be the amount of profit after tax. So if I want to arrive at the profit before tax, what I need to do is add back the amount of tax that was deducted. So how do we compute the amount of tax? considering if this is 66%, how much will be 34%, and adding the two, we get the profit before tax as 152 in terms of rupees lakhs. Now, this profit is already influenced by some extraordinary items which are not expected to recur in the future. As a result, we need to nullify the effect of extraordinary items. So, extraordinary loss which was already deducted, we will add it back because this is not expected to arise in future, and extraordinary income which was part of your profit should be excluded because this is not expected to again recur in the future. So, profit from ordinary activities is obtained as 143 lakhs. Then we add new component of profit from the new product, and for that you just take sales and subtract all the components of cost as material, labor and fixed cost, and we get the profit from the new product as 24 lakhs. Now the overall expected profit before tax will be 167 lakhs, and then you subtract tax at 34% and we get the future maintainable profit after tax, or you can call it expected profit after tax, as 110.22 lakhs. Please write up this much and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and look into the value of business when the capitalization rate is 12%. So can you understand, the business has a future maintainable profit of 110.22 lakhs and the capitalization rate is 12%. What does that mean? That you are expecting a rate of return of 12% and the expected amount of return is 110.22 lakhs. So the idea is very clear. If 12% is expected rate of return and the amount of return is 110.22 lakhs, what would be the capitalized value, or what would be the value of your entire business? That comes to 918.5 lakhs. Simple idea is, if this 110.22 is 12%, how much is 100%? That is what we want to find out. Now this is the value of the business, and if you want to determine the market price per share, what you need to do is, you take the future maintainable profit after tax, subtract preference dividend because that will not be available for the equity shareholders. So the earnings that will be available to equity shareholders will be the earnings after subtracting the preference dividend, and these earnings available to equity shareholders when divided by number of equity shares would give you EPS as rupees 2.06. Price earning ratio is given as 6 times, so you can easily figure out that the market price per share would be rupees 12.36. So please write up this much and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue with the next question, that is question number 2A. Now reading this question, it says standard deviation of security X is given as 12%, standard deviation of security Y is given as 7%, standard deviation of market is given as 10%. Correlation between X and market is given as 0.8, correlation between Y and market is given as 0.7, and correlation between X and Y is given as 0.9. You are required to determine the following: variance and standard deviation of portfolio if weight of security X and security Y is 0.6 and 0.4 respectively. Second thing, the question is asking you to determine portfolio beta, and lastly the question is asking you the systematic and unsystematic risk of the portfolio. So first of all, if you want to find the variance and standard deviation of the portfolio where the weights of the securities are informed to you as 0.6 and 0.4, look at one thing. As per Markowitz model of portfolio risk, the standard deviation of individual securities are given, their weights are given, and most importantly the correlation between the two securities is also given. This is enough information to find the absolute risk, which could be indicated in the form of the variance or standard deviation of the portfolio, and let me show you how to determine that. So what you are finding over here is the variance of the portfolio, and this is the approach used by Markowitz for determining the absolute risk of any portfolio or the total risk of any portfolio. When you substitute all the values, what you get as the portfolio variance comes to 95.968. Don't use percentage sign with the variance, keep that thing in mind. Sigma p squared indicates the variance of the portfolio returns, and the standard deviation of the portfolio will be the square root of the variance, that will be square root of 95.968, and the standard deviation of the portfolio comes to 9.796%. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this much, let me take you ahead, and the next thing that we have to do is to determine portfolio beta. But for that purpose, you will have to first determine the beta of each individual security. So you know how to compute beta when you have information about standard deviation of stock, standard deviation of market returns, and the correlation between the returns of your stock and the market. You can easily compute the beta of that individual security. And once you get the beta of both of these individual securities, you take the weighted average of these betas, and that will be the beta of portfolio. So portfolio beta will be beta of x into weight of x plus beta of y into weight of y. When you substitute these values, you get 0.772 as portfolio beta. So please write up this working and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead, and now what we do is we determine the systematic and unsystematic risk for the portfolio. Because the question did not mention any approach, we will always prefer the variance approach, and as per this approach the total risk will be the variance of the portfolio, that is 95.968. The systematic risk will be the variance of market multiplied by beta of portfolio squared, and that will be 10 square into 0.772 squared. That will be 10 square as 100 and 0.772 squared as 0.5960. So what we get as systematic risk will be 59.6, and the balancing figure will be the residuary risk, which we also call as unsystematic risk, that will be 36.368. So please write up this part as well and then I take you ahead. Alright friends, I am sure you have completed writing this much. Let us move ahead and take up the next question, that will be question 2b. Now in your textbook, this is given as a question number 9 of the topic mutual funds. So let me read this question for you. Mr. Suhail has invested in 3 mutual fund schemes as given below. So there are 3 schemes: scheme A, scheme B, scheme C. Date of investment: for each scheme there is a different date of investment and different amount invested in each scheme. Net asset value or NAV at the entry date is given. Dividend received up to 31/7/2011 is given, and NAV as at 31/7/2011 is also given. You are required to calculate the effective yield on per annum basis in respect of each of the 3 schemes to Mr. Suhail up to 31/07/2011, that is 31st July 2011. Take 1 year equals to 365 days. Show calculations up to 2 decimal points. Basically again this is a very simple question. Look at one thing. Amount invested in scheme A is 12 lakhs. Now at the entry date, what is the NAV? That can help you to understand how many units you have purchased. Secondly, we have also been informed about the dividend received up to this date, and can you notice the date of investment and the date on which you have to compute the returns? These dates, you will find the gap between these 2 dates as the holding period for scheme A, that will be computed in number of days, and you will therefore first calculate the holding period return. That means the rate of return that you will calculate will be from 1/4/2011 to 31/7/2011. However, question is asking you to find the annualized rate of return. So you will count the number of days and accordingly you will just fix up the rate of return on annualized basis after computing the holding period return. So let us just see how to present the solution. Once I explain you something for scheme A, in the same pattern you can make the calculation for scheme B and C. It will be better to present this kind of solution on columnar basis so that your presentation of solution is quick as well as very clear. So let us look into the same. So first you do one thing, you calculate the number of units and number of days. So amount invested in each of the scheme and the NAV at the entry date. When you consider these two factors, you will be able to identify the number of units that you have purchased. Let me remind you one thing, that mutual fund units can be purchased in fractional quantity also. So don't ever try to round off these number of units, and in fact question has mentioned very clearly that show calculations in 2 decimal points. And let me tell you this thing very clearly, mutual fund units practically can be purchased in fractional quantity. So now this number of units once we have identified, the date of investment is given in the question and the number of days up to 31st July 2011 we will have to count. So number of days what we find is 122 days for scheme A. Look into one thing, how do you get this number of days? So you have made investment on 1st of April 2011, so you will count 30 days of April, you will count 31 days of May, 30 days of June and 31 days of July. So while counting the number of days, you have included this date basically. So if you have invested on 1/4/2011 and you have stayed invested till 31st July 2011, your total investment period is 122 days for scheme A. Likewise, you can understand how we have made calculation for scheme B and C. So please write up this entire thing and then I take you ahead. Alright friends, once you have completed writing this part of the solution, let us proceed ahead and write up further. You will now calculate the total yield. Now this can be done by applying the formula or you can make the calculation in tabular format. So number of units what we have computed multiplied by NAV as at the end of the period, we will be getting the total value of your investment by end of the period minus the initial investment. So this is giving you the growth part, that is gap between NAV1 and NAV0, and of course considered in terms of the total number of units held. So the capital yield what you get or the growth what you got, it is negative in scheme A and scheme C, it is positive in scheme B. Of course to this you will add the dividend yield, so your total yield will be aggregate of these two. So we find that in scheme A and B you have made a gain, scheme C you have incurred a loss, and now we have to find the effective yield on a per annum basis. Why per annum basis? Because question has asked the annualized yield. Now what we will do is we will first compute the yield in terms of percentage and then we convert that percentage from holding period to per annum. Before I take you any further, first write up this much, and I have purposely kept this line blank. We will make a working note for effective yield per annum and then we will fill up the values over here. First what you do is you quickly write up this entire table. Alright friends, after writing up this entire table, let us move ahead, and what we now do is we first calculate the effective yield per annum. So what we will do basically, the total yield in amount divided by the amount invested multiplied by 100 will give you the yield in terms of the holding period. But the moment you take this adjustment factor, that is 365 divided by number of days that you have stayed invested, automatically the calculation will be directly the effective yield per annum. So instead of making the calculation in two stages, that we first calculate HPR and then convert into annualized return, we can have a direct calculation like this. And now just you have to substitute the values for each scheme as per the table that we have drawn earlier. and once you get the effective yield for each scheme, you can substitute these values in the last line of that table. I'll show you that as well, but first what you do is you carefully note down these calculations, and let me remind you, please do not copy the calculations. Use your calculator, check the calculations and write it. Copying will not help you. So please write up this whole thing, and then I take you back to the table where we will fill up all these values. Alright friends, once your effective yield per annum is computed, we can go back to the table, and the last line that was kept pending, we can just fill up those three values over here. So please write up this one line additionally, and it will be end of the solution. Alright friends, once you have completed this entire solution, let us move ahead and take up the next question, that will be question 2C. Now this question is question number 100 from your portfolio topic. So let us deal with this as well. Stock A has an expected return of 18% and a standard deviation of 30%. Stock B has an expected return of 12% and a standard deviation of 36%. The correlation between the two stocks is 0.25. If you form a portfolio where you put 40% of your money in A and 60% in B, what is the expected return and standard deviation for the portfolio? That is the first part of the question. Second part says, how will the expected return and standard deviation change if the correlation between the two stocks is 0? And third part of the question says, at what level of correlation coefficient the risk would be least? Compute such minimum risk. Now guys, you have learned one thing very well, that when there is a change in the correlation, the return on portfolio does not change, but what will change definitely is the standard deviation of the portfolio. So when the correlation initially informed to you was 0.25, if that reduces to 0, the portfolio returns will not change, but portfolio risk in terms of standard deviation, in other words the standard deviation of the portfolio, will definitely reduce. Now at what level of correlation coefficient the risk would be least? That means what can bring down the risk to as low as possible. Here we are not supposed to change the weights of the stocks. We have to consider the variable as the correlation, and we have learned one thing, when the correlation between the two stocks is a perfect negative correlation, the risk can be minimum. So let us do one thing, let us look into how to present the solution. In the first part, you just write up the details of the returns and standard deviation of stock A, likewise returns and standard deviation of stock B, and then what you do is also mention what is the correlation between A and B. Just write up this quickly and then I take you ahead. Alright friends, let us move ahead, and now what we do is we compute the return on portfolio, which will be the weighted average of returns of A and B, and the weighted average returns is coming to 14.4%. Now the standard deviation of the portfolio as per Markowitz model, it will be sigma p equals to square root of sigma a square into WA square plus sigma b square into WB square plus 2 times sigma A into sigma B into weight of A into weight of B into correlation between A and B. Each information is clearly available. We have already written those variables in the earlier page, and now we are just substituting the values. This being a practice question, actually you should not need my help in solving it, but just a little bit of guidance, and that is what I am providing to you. So when you compute standard deviation, it is coming to 27.21%. So this is the standard deviation of the portfolio where the correlation coefficient was 0.25. So please write up this part of the solution, and then I'll show you what happens when the correlation is brought down to 0. Alright friends, I'm sure you have finished writing this whole thing. Let us move ahead and work out what happens when the correlation between stocks A and B is 0. RP, that is the return on portfolio, will still remain the same. The standard deviation of portfolio will change. Basically, the whole formula remains same. The last term over here, that was the correlation between A and B, instead of 0.25, now we have substituted this to 0. As an impact, this whole third term will become 0 because a 0 is getting multiplied to this whole thing. So we are just going to have the first term and second term aggregate, third term will be 0. So standard deviation of portfolio will be square root of 144 plus 466.56. Standard deviation of portfolio reduces to 24.71%. Please write up this as well and then I take you ahead. Alright friends, I am sure you would have finished writing this whole thing. Let us move ahead and deal with the last part of the question. It is known that portfolio risk can be minimized when correlation between the two securities forming the portfolio is perfectly negative. That means correlation should be -1. So again, to compute sigma p, that is standard deviation of the portfolio, we use the same formula with one change, that the last term correlation between A and B, can you see it has now been substituted for -1. As a result, this entire last term will become negative, and let us see what will be the impact of that. Sigma p will be square root of 144 plus 466.56 minus 518.4, and that gives you standard deviation of portfolio as just 9.6% only. Now have you noticed one thing? The standard deviation of the portfolio has substantially got reduced, but it has not been brought down to 0. If you want to bring down the portfolio standard deviation to 0, apart from having perfect negative correlation between A and B, you need one more thing, that is optimal weights, that we have learnt in earlier questions. The optimal weight concept you have to introduce. However, weights of the two securities were very clearly mentioned in the question. Weight of A was 40% and weight of B was 60%. Because we are not supposed to change the weights, we cannot bring down the portfolio risk to 0. Anyway, please write up this whole thing and that will be end of this entire solution. Alright friends, once you have completed writing this solution, let us move ahead and take up the next one. That will be question number 3A. This will be question number 16 from your textbook, which is again from the topic mutual funds. Let us read this question. A mutual fund company has the following assets under it on the close of the business as on. So as on, and then they have given two dates, 1st February 2022 and 2nd February 2022, and they have basically given you the market price per share. Now if you see, the shares of 4 companies are held by this mutual fund, that is L, M, N and P, and the number of shares they have given. So market value of each share or market price of each share is given on 1st February as well as 2nd February, and then they have given you total number of units as 6 lakh units. Now what is required in the question? Calculate the net asset value of the fund as on 1st February 2022. The B point of the question says following information is given as on 1st February 2022, assuming that on the evening of the day, one investor, Mr. A, submits a check of rupees 30 lakhs to the mutual fund, and the fund manager of this company purchases 8,000 shares of M Limited, and the balance amount is held in bank. In such a case, what would be the position of the fund? Third part of the question, C part, it says find the new NAV of the fund as on 2nd February 2022. So in order to solve this question, you first understand what all we have to do. Let me take you back to the previous slide. Observe one thing. The first part of the question can be solved by taking the number of shares multiplied by the market price per share. That will be the NAV of the fund. So NAV of the fund will be basically the market value of all the investments as on 1st February 2022. That will be before the check was deposited by that investor. Now after that investor has given that additional check of 30 lakhs, two things will happen. First of all, the mutual fund company will be buying additional shares in one of these companies. It is given as M Limited. It will be buying additional 8,000 shares in M Limited at whatever market price prevailing on that date. And not only that, because this investor has given cash contribution to the mutual fund company will be issuing additional units to this investor at the NAV of that date. So we have to first find NAV before that check was deposited, then we have to find the position after the check was deposited and after additional shares were purchased in M Limited and after the additional units were issued to the investor. All this will be done still on 1st February. Then the question is also asking in the third part, that is C part, the position as on 2nd February, that is the next day. So basically in the next day, whatever be the revised number of shares and units will prevail as it is. Only difference is the market price of these shares will be altered and you will be taking the revised position as on 2nd February 2022. So let us be little careful while presenting the solution because three different parts we have to answer, A, B, C. So let us begin with the first part and you just write the heading, position of the fund as on 1st February 2022. This is the position before investment made by Mr. A. Investments by a mutual fund are marked to market. Therefore, the value of investment for computing NAV will be taken at market value as on 1st February 2022. In this case, there is only one asset given in the question, that is investments. So net assets will be the market value of investments and we will compute the market value of investments. But first what I want you to do is write this paragraph quickly. Alright friends, after writing this paragraph, let us move ahead and now what we do is calculation of market value of investments. So just multiply the number of shares with the market price per share and you get the amount in rupees in terms of market value of investment. Do the same for each of these four companies and once you get the aggregate of these amounts in rupees, that will be basically the total value of investment. So NAV of the fund will be the total net assets amount, that is 4,73,02,000 divided by the total number of units outstanding. So that is 4,73,02,000 divided by 6 lakh units, that comes to rupees 78.84 approximately. So basically don't forget, this is the position before that investor has deposited a check with this mutual fund. So this is the position before depositing that check. So please write up this whole thing and then we look into the position after the check was deposited, after additional shares were purchased and after the additional units were issued. But first you please write up this whole thing. Alright friends, once these calculations are done, let us move ahead and look into the position after the check was deposited by Mr. A. So after considering rupees 30 lakhs investment made by Mr. A, you first work out the cash balance. Investment made by Mr. A was 30 lakhs. Purchase of additional shares in M Limited. These were 8,000 shares purchased at 312.4. This is basically the market price per share as on that same date, that is 1st February 2022. So that results into the total outflow by the mutual fund as 24,99,200. Balance amount will be the cash balance remaining with the mutual fund, that will be rupees 5,08,000. And now we have to also work out the additional units that were issued by the mutual fund on this investment of 30 lakhs. So original units outstanding were 6 lakh units. Units issued to Mr. A, 30 lakhs divided by rupees 78.84 approx, or you can write 78.8366, whatever. This will give you the number of units to be issued to Mr. A, and once you get the aggregate of these two, it will be the total number of units outstanding after this transaction happened on 1st February 2022. So please write up this whole thing and then I take you ahead. Alright friends, once we have completed writing this working, let us move ahead, and now what we do is we compute the revised net assets on 1st February 2022. So market value of investment as shown above, it was 4 crore 73 lakh 2000. Additional shares that were purchased, just add that to the existing market value and add the cash balance. Your revised net assets balance will be rupees 5 crore 3 lakh 2000, and NAV for each unit will be this revised value divided by the revised number of units, and that comes to still rupees 78.84 per unit. Don't forget that on the same date additional units were issued, the value of assets hasn't undergone any change. How you can prove it? Check this amount. This amount was the value of investment before the check was deposited by Mr. A. Aggregate of these two amounts will be 30 lakhs. So 30 lakhs added to this amount, it will become 5 crore 3 lakh 2000, and exactly in the same proportion the units have been issued. So obviously the NAV per unit cannot change, NAV per unit still remains same. So please write up this whole thing and then we deal with the third and last part of the question. Alright friends, after you have completed this working, let us move ahead and deal with the last part. And here you have to find the position of the fund on 2nd February 2022. You now compute the net assets following the same approach. For each company, take the number of shares multiplied by the market price per share. However, the market price that you will now consider will be the market price prevailing on 2nd February 2022. And for company M, don't forget that you have to count the revised number of shares as 38,000 shares, 30,000 shares lying earlier and 8,000 shares newly purchased on 1st February 2022, and multiply with the market price prevailing on 2nd February, and this is the position of the net assets that you will get. So this will be the market value of investment. The cash balance that was lying with you on 1st February remains the same on 2nd February because there were no separate transactions informed, and the net asset value comes to 5 crore 24 lakh 86,800. Dividing that by the same number of units, you get the revised NAV per unit as rupees 82.26 per unit. So please write up this whole thing and that will be end of the solution. Alright friends, so once you have completed writing this solution, let us move ahead and take up the next question, that will be question number 3B. And this question I have picked up from question number 39 of the topic share valuation. So let us deal with this as well. ABB Limited has a surplus cash balance of rupees 180 lakhs and wants to distribute 50% of it to the equity shareholders. The company decides to buy back equity shares. The company estimates that its equity share price after repurchase is likely to be 15% above the buyback price if the buyback route is taken. Other information is as under: number of equity shares outstanding at present, that is face value of rupees 10 each, it is 20 lakh shares, and the current EPS is rupees 5. Further, what they have asked in the question, you are required to calculate the following: the price at which the equity shares can be repurchased if market capitalization of the company should be rupees 400 lakhs after the buyback. Second thing what they are asking is number of equity shares that can be repurchased. Third thing what they are asking is the impact of equity shares repurchase on EPS assuming that the net income remains unchanged. So the profit of the company remains unchanged, that is what they are trying to provide you as a hint. Now to solve this question, it is very simple. We have all the parameters available. So let me show you how to present the solution over here. Let P be the buyback price decided by ABB Limited. and the market capitalization after the buyback what they want is rupees 400 lakhs. Now look at one thing. How will you show the impact of this? Look at this point very well. Original number of shares that are given to you minus the number of shares that you will buy back will be the remaining shares, correct? In the brackets what I am going to show is the remaining number of shares after buyback, and those remaining number of shares will be multiplied to the market price per share after the buyback, and they are expecting that the market price per share will be 15% more than the price of the buyback. That means whatever be the buyback offer price which we have assumed as P, the market price after that, that is after the process of buyback, will be 1.15 times of P or 15% greater than P, and the post buyback market price multiplied to the remaining number of shares would obviously give you the total market capitalization after the buyback, which is expected to be 400 lakhs. So whatever values are available, let us try to substitute those values in this equation. So the left hand side of the equation remains as it is, that is 400 lakhs copied over here. 1.15p multiplied by, within brackets, now original number of shares were 20 lakh shares, and how will we know the number of shares to be bought back? Very simple. Company is having 180 lakhs of cash surplus and they want to utilize 50% of that for the process of buyback. Now 50% of 180 lakhs will be 90 lakhs. 90 lakhs will be the amount utilized for buyback, and each share will be bought back at the price of P. So if I divide 90 lakhs by P, I will be obviously getting the number of shares to be bought back. Number of shares to be bought back, when subtracted from the original number of shares, I will be getting the revised number of shares after the buyback. And when I solve this equation, what I get, 1.15p multiplied by 20 lakhs will give you 23 lakhs P, that is 23 lakhs into P, and 1.15p multiplied by this 90 lakhs divided by P. So what will happen? P and P will get cancelled. So 1.15 multiplied by 90 lakhs is what you get over this side, of course with a minus sign before that. Now if we go with the entire equation, the left hand side of the equation remains 400 lakhs as it is, and in the right hand side we would write 23 lakhs into P minus 1.15 times 90 lakhs, that would give you 103.5 lakhs. Now I can easily identify the value of P through this. So what I do is 23 lakhs into P remains one side, and this negative 103.5 lakhs goes and gets added to 400 lakhs, and I get the equation this way, and then I can comfortably find the value of P by dividing 503.5 lakhs by 23 lakhs, and the value of P comes to rupees 21.89 per share. So this is the offer price for the buyback, and before I take you ahead, please take note of this part of the solution. Alright friends, once you have completed writing this whole thing, let me take you ahead and show the remaining part of the solution. So the number of shares to be bought back will be rupees 90 lakhs divided by the buyback price, and that will give you 4,11,147 shares. So the number of shares after the buyback will be 20 lakh shares minus the number of shares bought back, that is 20 lakhs minus 4,11,147, which will give you 15,88,853 shares. Impact of buyback on EPS. So your EPS was rupees 5 and the number of shares were 20 lakhs. So the overall net income, that is the net income available to equity shareholders, would be rupees 5 multiplied by 20 lakhs. That would be remaining same, but the number of shares now after the buyback will get reduced, and we will be getting the EPS as rupees 6.29 per share. So we can say that the EPS of the company increases to rupees 6.29 and it is increased by rupees 1.29. That will be the effect of buyback on EPS. So please take note of this whole thing, and that will be end of the solution. Alright friends, once you have completed writing this solution, let us move ahead and take up the next one, that will be question number 3C. Now this question is question number 3 from the topic corporate valuation. So let us read this question as well. Tiger Limited has Bloodlust as a separate division. The division is likely to give cash flows after tax to the extent of rupees 5 lakhs for the first year, and such cash flows are expected to grow at 8% per annum up to end of 6 years. Tiger Limited has planned that after 6 years, this division would be demerged and disposed of at its terminal value, which is expected to be 15% more than the value based on perpetual growth. The company's cost of capital is 16%. Determine the total enterprise value as per cash flow based valuation. Net present value for 16% for rupee 1 are as follows. So they have given you the PV factors. Now, how would you apply this concept of cash flow based valuation in this scenario? Let us first of all understand what is given. So cash flow for the first year is given as 5 lakhs. Thereafter the cash flows would grow at 8% up to 6 years. And what happens after 6 years in this case? After 6 years the division would demerge, right? So it would demerge, but division would still exist, correct? And the cash flows would continue to generate at 8%. So what you would do is you would arrive at a terminal value at end of 6 years, but that terminal value which you calculate based on the perpetual growth model will not be the terminal value that you will consider, because that value is expected to be 15% more than the value based on perpetual growth. In other words, you will first definitely find the value as per perpetual growth. To that you would add 15%, which will be the disposal value or terminal value, and then once you have all these future values, you will arrive at the present value of these future cash flows and future values. So let us do one thing. Let us see how to present the solution. D1, I am on purpose writing D1 as representing the cash flow of the first year, which is already given as 5 lakhs. D2 will be the cash flow of second year. So cash flow of second year will be 8% more than the first year's cash flow. So it will be 5 lakh plus 8%. D3 will be further 8% more than D2, and we go on like that up to D5, D6, and we also compute D7. Don't forget that after 6 years the terminal value has to be computed, that will be P6, correct? And P6 will depend upon D7. So as per perpetual growth, P6 will be D7 upon KE minus G, and that would be the D7 value divided by KE minus G, and whatever you get will be the terminal value as per perpetual growth. But that will not be accepted as it is, because the real terminal value on disposal would be 15% more than the value as per perpetual growth. So what you get as P6 value, on that you add 15% to arrive at the proper terminal value. So do one thing friends, write up all this and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us now move ahead and determine the present value of all these future cash flows and the future terminal value. So what we would do is year cash flow PV factors at 16% and PV of cash flows. So year 1, 2, 3, 4, 5, 6 and 6. We have written 6 twice, one for the usual cash flow of 6th year and one will be for the terminal value. So terminal value, it is obviously after that 15% adjustment, and now PV factors are already given in the question. We would multiply these PV factors to the cash flows and what we would get is PV of cash flows, and when you add it up you get the total PV or the present value of the future cash flows and values. So that is 68,55,061. So note down this whole thing and then we shall move ahead. Alright friends, once you have completed this entire solution, let us move ahead and take up the next one. That will be question number 4A. Now this particular question from the textbook, it is question number 43 of share valuation. Let us look into this. Mr. X, a financial analyst, intends to value the business of PQR Limited in terms of the future cash flow generating capacity. He has projected the following after tax cash flows. So they have given you cash flows after tax for 5 years. Then it is further estimated that beyond 5th year, cash flows will perpetuate at a constant growth rate of 8%, mainly on account of inflation. The perpetual cash flow is estimated to be rupees 10,260 lakhs at the end of 5th year. Now this is a very important line. By chance they would not have given this line, I would have taken 5th year cash flow and applied growth rate on that. But for your perpetual computation, they have given the cash flow base at end of 5th year to be 10,260 and not this usual cash flow. That means the initial 5 years we may have the initial establishment of the business where the cash flows would be very less. Thereafter we take the base of 10,260 and we adjust the growth rate to arrive at the 6th year cash flow, and based on that we will find the terminal value. Let us read the question ahead. It says required, what is the value of the firm in terms of expected future cash flow if the cost of capital of the firm is 20%. So KE will be taken as 20%. The firm has outstanding debts of rupees 3,620 lakhs and cash bank balance of 2,710 lakhs. Calculate the shareholder value per share if the number of shares outstanding is 151.50 lakhs. The firm has received a takeover bid from XYZ Limited of rupees 225 per share. Is it a good offer? Now of course we will have to work out the value of the share, and then if this offer is greater than that, definitely that bid offer is acceptable. And now they have given you at 20% rate of return the present value factors for year 1 to 5. So enough information for us, we can straight away go ahead with the solution. In the solution, what do we find? The terminal value first of all. So I have already explained you, they have specifically given that by end of 5th year the terminal value base of cash flow should be 10,260. So this is not the terminal value at end of 5th year, this is the cash flow base at end of 5th year for the purpose of perpetual growth, and the growth rate over there is going to be 8%. So first of all what we should do is we should add 8% to 10,260 lakhs to arrive at the expected cash flow at 6th year. So the terminal value can be computed as cash flow of 6th year divided by K minus G. So because cash flow of 6th year is not directly informed, we will take 1 plus growth rate multiplied to cash flow of 5th year to have the adjusted cash flow of 6th year divided by K minus G. So that comes to 10,620 into 1.08 divided by 0.20 minus 0.08. And that will be 11,080.8 divided by 0.12, that comes to rupees 92,340 lakhs. So please write up this entire working and then I take you ahead. Alright friends, once you have completed writing this terminal value working, let us move ahead and try to work out the total value of the firm. You simply make a table and year 1, 2, 3, 4 and 5. The cash flows of these 5 years are clearly given. PV factors have also been given in the question. Just multiply the respective PV factors to the cash flows in lakhs of rupees and you get the present value of cash flow up to 5th year. To this we have to add the present value of terminal value, which will be 92,340 into 0.402 in terms of lakhs, and that comes to 37,120.68 lakhs. Aggregate will be the total value of the firm. First you work out this whole thing and then I take you ahead. Alright friends, I am sure you have completed writing this working. Let us move ahead and now calculate the value of the share. Very simple task. Total value of the firm minus the value of debt divided by number of shares. So that will be all calculations in lakhs. So it is 40,175.30 lakhs minus 3620 lakhs, both in lakhs of rupees, and the denominator, that is number of shares, is basically 151.50 lakhs. So the final value will be the value per share, that is 241.29. This is the fair value of the share, and the takeover bid is rupees 225, which seems to be not a good offer, as it is lesser than the intrinsic value per share, that is the value of share being 241.29. We should not accept the bid as 225. This takeover bid should be rejected. So please write up this whole thing with the concluding line, and that will be end of the solution. Alright friends, once we have completed this entire solution, let us move ahead and take up the next question, that will be question 4b. Now this question is basically question number 30 from your textbook, and the question is from the topic bond valuation. So let us deal with this as well. Messrs Earth Limited has 11% bond worth of rupees 2 crores outstanding with 10 years remaining to maturity. The company is contemplating the issue of a rupees 10 crore 10-year bond carrying the coupon rate of 9% and use the proceeds to liquidate the old bonds. The unamortized portion of issue cost on old bond is rupees 3 lakhs, which can be written off no sooner the old bonds are called. The company is paying 30% tax and its after-tax cost of debt is 7%. Should Earth Limited liquidate the old bonds, you may assume that the issue cost of new bonds will be rupees 2.5 lakhs and the call premium is 5%. So friends, the existing bonds had remaining life of 10 years and the new bond also is for a life of 10 years. Now the existing bond redeemable value and the new bond redeemable value have not been given in the question. So it is implied that on maturity these bonds must have been redeemable at par. So anyway, let us see how to present the solution. So we will follow the usual steps, that will be first to determine the cash flows arising at 0 year if the bond is replaced. What you would simply do is you would find the proceeds from issue of new bonds at par, that will be rupees 2 crores. Issue expenses on new bonds will be 2,50,000, it will be a negative cash flow. Redemption of existing bond at 5% premium will be 2 crore 10 lakhs, correct? 2 crore plus 5%, 2 crore 10 lakhs. And on that 10 lakhs of premium, you are going to save tax of 30%, and that will be rupees 3 lakhs. Now whatever be the unamortized portion of issue expenses of old bond that you are going to write off immediately will be 3 lakhs of that unamortized amount multiplied by tax rate 30%, that will be tax saved on that unamortized portion, which will be 30% of 3 lakhs, and that comes to 90,000. No other cash flows will arise at 0 year. So final cash flow at 0 year on net basis comes to negative 8,60,000. So take note of all these calculations and then we move ahead. Alright friends, you would have finished writing these calculations. Let us move ahead and determine the calculations for year 1 to 10, that is annual cash flows that arise because of replacement of existing bonds with the new one during year 1 to 10 on annual recurring basis. So what we first do is we consider the post-tax interest on existing bonds that you will save. 2 crores is the nominal value, 11% is the present coupon rate, and we want to take the post-tax effects. So 1 minus tax rate, finally the post-tax amount of that interest that we are going to save every year will be 15,40,000, and on the new bond you are going to pay interest at 9%, and post-tax effect of that comes to 12,60,000. So 15,40,000 saved and 12,60,000 incurred every year for 10 years. After that, the amortization tax shield on existing bonds that you would have obtained on a recurring basis, which now you have to forego, is 9,000. I want you to once again pay attention on this point. 3 lakh was the unamortized portion. If you would not have replaced the bond, you would have amortized this over next 10 years. That would be 30,000 each year, and 30% of that you would have saved as tax, that is 9,000. However, because of the replacement of bond, you are going to forego this 9,000. However, the new amortization tax shield that now arises will be 2,50,000 of expense on issue amortized over 10 years, and each year's amortized amount subject to tax rate of 30% will result into amortization tax shield of 7,500 each year. Finally, the net total of this will be the net cash flow during year 1 to 10, and that works out to rupees 2,78,500. So friends, please carefully take note of these cash flows and then we move ahead. Alright friends, you would have finished writing this whole thing. Now I have discussed one point earlier, that the question does not give any information about the redemption value after 10 years of the existing bond or of the new bond. So it is obvious that the bonds are redeemable at par at their maturity. Because both the bonds have same nominal value and they are redeemable at par, because of replacement of bond there will be no cash flows that will arise at end of 10th year, and therefore no workings have been shown in that regard. So now what you do is simply compute the present value of replacement decision, and here the cash flows that we consider will be the cash flows arising at 0 year and cash flows arising on recurring basis from year 1 to 10. These cash flows are negative 8,60,000 and positive 278,500. PV factors for 0 year will be 1, and for year 1 to 10 at 7% discounting rate basis it will be annuity factor of 7.023582. When these factors multiplied to the respective cash flows, you get the present value of cash flows in the form of net present value, that is 10,96,067 positive. Conclusion: as the NPV of replacement decision is positive, the company should replace its existing bonds with the new bonds. So friends, do one thing, take note of these calculations also, and that will be end of the solution. Alright friends, once you have completed writing this much, let us move ahead and take up the next question, that is question number 4C. Now this will be question number 11 from your textbook, and that is from mutual funds. So let us deal with this. Orange purchased 200 units of Oxygen Mutual Fund at rupees 45 per unit on 31st December 2009. In 2010, he received rupee 1 as dividend per unit and capital gain distributions of rupees 2 per unit. Required: calculate the return for the period of 1 year, assuming that NAV on 31st December 2010 was rupees 48 per unit. Now if you closely observe, you have the information of NAV 0. This is NAV 0, right? NAV prevailing on the date when the units were acquired. These two are the distributions, right? I1 and G1, and this is NAV 1 reported on 31st December 2010 by end of the year, or you can say by end of the period. Here period is 1 year, so you don't have to calculate holding period return. It will be simply the rate of return, which will be annual rate of return. Now the next part of the question is asking you, calculate the return for the period of 1 year, assuming that the NAV on 31st December 2010 was 48 per unit and all dividends and capital gains distributions have been reinvested at an average price of rupees 46 per unit. So basically 48 per unit is the NAV on the last date, but the reinvestment was made at the rate of 46 per unit, and the question has asked you to ignore taxation. Now the only different kind of calculation what is required is in the second part. First part is as usual. So let us look into how to present the solution over here. Rate of return can simply be computed by taking NAV1 minus NAV0 plus I1 plus G1 divided by NAV0, where NAV1 is NAV at end of the year, NAV0 is NAV at the beginning of the year, I1 is distribution on account of income, and G1 is distribution on account of capital gain. Then you write up the values. We have all the values directly available, and we get the annual rate of return as 13.33%. So please write up this calculation and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and deal with the next part of the question. Now here you have to be careful. If all the dividends and capital gains are reinvested into additional units at rupees 46 per unit, the position would be as follows. So determining total number of units. First of all, look into one thing. The distribution on each mutual fund unit was rupee 1 and rupees 2 on account of the income distribution and capital gain distribution respectively. That means this investor would have received rupees 3 per unit as distribution. Now this rupees 3 per unit should be multiplied to the number of units this investor originally had, and those were 200 units. So the total amount that would have been received and got reinvested must be rupees 600. Reinvestment, however, was made not at 48 but at 46. So what will happen? The additional units that will be purchased by this investor comes to 13.04 units. So that amount of 600 got reinvested at the rate of rupees 46 per unit, resulting into 13.04 additional units. And original units held by this investor were 200 units. So the revised holding will now be 213.04. Now keep precaution of one thing. Using the formula, you will not compute the rate of return now, because in between the number of units have got changed. So because the number of units have got changed, you have to now compute the rate of return based on the value originally invested and the final value that has been in the hands of the investor by end of the year. One more thing I would want to convey over here. These 13.04 units, when these were purchased at 46, even these units will have some gain in their value, because by end of the year the NAV per unit became 48 and doesn't remain 46. So this will be putting some additional return for the investor, and therefore it is obvious that the rate of return will be little higher than the rate of return that you would have observed in the earlier scenario. So first write up this calculation and then I take you ahead. Alright friends, once you have finished writing this much, let us move ahead and make the calculations further. Investment value at end of the year will be number of units at end into NAV at the end of the year, and that will be 213.04 units multiplied by 48 per unit. That comes to rupees 10,225.92. Amount paid at the beginning of the year will be original number of units that were purchased, that were 200 units multiplied by NAV as on that date. That will be 200 units multiplied by rupees 45 per unit, and that will be rupees 9,000. You just have to now look into one thing. The wealth of the investor at the beginning of the year when the investment was made was 9,000, and end of the year the wealth is 10,225.92. There is no cash balance left in the hands of the investor because all the cash has been reinvested in the same units. As a result, if this is value at the beginning, if this is value at the end, you know how we do. P1 minus P0 divided by P0 will give you the rate of return. You can just compute it as a short calculation after this, but first finish writing this much quickly. Alright friends, once you have finished writing this much, let us move ahead and deal with the last part. The rate of return will be V1 minus V0 divided by V0, where V1 is the investment value at end of the year and V0 is the investment value at the beginning of the year, or amount paid at the beginning of the year, and when you put that calculation over here, you get 13.62%. We knew one thing, that this is going to be little higher rewarding when you are reinvesting your units during the year, because the date on which the reinvestment was done, that day the additional units were bought at 46, and by end of the year the value is 48. So it is obvious that you will be having little additional return or little higher return under this kind of strategy. So we may also write up a conclusion from the above. It can be said that reinvestment option is better, as the investor would earn a higher rate of return if he opts for investment of distributions received during the year. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this entire solution, let us move ahead and take up the next question, that is question number 5A. A very important question from corporate valuation and from the segment that is economic value added. From the book it is question number 17. Let us deal with this. Following is the balance sheet of NJ Limited as at 1/4/2020. So balance sheet given at 1/4/2020. You have been given non-current assets and current assets, 7,000 and 5,000, totaling to rupees 12,000. Then you have equity and liabilities. You have equity share capital amounting to 2,000, reserves amounting to 3,000, 10% debt amounting to 5,000, and in the balance sheet itself you have been given total capital employed, that is rupees 10,000, and then current liabilities added 2,000. The total of your equity and liabilities also comes to 12,000. Let us move ahead and read further. For the year ended 31/3/2021, the company achieved total sales of rupees 15,000. Cost of goods sold is 70% of sales. The company incurred operating expenses of rupees 2,000. Tax rate is 30%. The company uses capital asset pricing model for determining the cost of equity. For this purpose, following information is available. Risk-free rate is given as 8% per annum. Rate of return in the market is 16% per annum. Beta of stock of NJ Limited is given as 1.5 times. And finally, what you are required to do is determine the economic value added for NJ Limited. Alright, if we try to understand what is given in this question and how you are going to approach the same, let us plan your solution in a systematic manner. First, based on this given information, you make up an income statement. That is, from sales you subtract the cost of goods sold, arrive at gross profit, subtract operating expenses, arrive at EBIT. Once you get to know what is EBIT, you have built a platform. Now, from EBIT, how to reach the net operating profit after tax, we have discussed that already. That step you are definitely going to apply. Then for computing capital charge, you need two typical information, that is the total amount of capital employed and the weighted average cost of capital. Total capital employed has been given in the question in the balance sheet itself. However, weighted average cost of capital will be simply the weighted average of two components of cost, because in this question we are finding only two components, that is debt and equity. Of course, equity includes reserves, so we have just two components of capital. Now, debt will have its own cost, which is identified as cost of debt. So you would work out a post-tax cost of debt, that is symbolized as KD. You would then work out KE, that is cost of equity, based on CAPM, which is demanded by the question. So you compute KD, you compute KE, and then the weighted average cost of capital can be easily determined. After you get weighted average cost of capital, apply that on the total capital employed and you get the capital charge, and you would have already worked out the net operating profit after tax. You can easily get the end result in the name of economic value added. So let us see how to write up the solution. With your solution, this is something that you have already mentioned. I don't think there will be any doubts over here, correct? EBIT is 2500. Thereafter, when you have to determine the net operating profit after tax, be careful over here. I told you two different approaches. So earnings before interest and tax is given as 2500. First subtract interest out of that, and what you get is earnings before tax. Once you get earnings before tax, this will be the proper amount of profit which will be subject to taxation, and on that you apply 30% tax. Tax rate is given as 30%. So 30% of 2000 would be 600. Subtracting that, you will get profit after tax. Now this is profit after tax. We want net operating profit after tax. So the post-tax effect of the amount of interest would be added back. What would be the post-tax effect of interest? I have explained you that also. It will be interest amount multiplied by 1 minus tax rate. Tax rate is 30%. So 1 minus tax rate would be 70%. 70% of interest amount would simply be 350. And when that added back, you would get net operating profit after tax, that is 1750. And then we have discussed alternative way of making this calculation, and this can simply be done by subtracting tax directly from EBIT. So what we are doing is we are again making starting point as EBIT, and this time we will directly apply tax on EBIT. So tax on EBIT, that will be 30% of rupees 2500. It would give you 750, and when you subtract 750 from 2500, you get net operating profit after tax, same amount as you got earlier. So in exam you can follow any approach. Obviously the second approach will be much easier and quicker, which we would prefer doing ahead. So I want all of you to write it down, and once you have completed writing, we will definitely move ahead. Let me now explain you what has to be done next. Now what needs to be done next is, you have already computed the first component, that is net operating profit after tax. What is now to be done? You have to arrive at capital charge, and capital charge will simply be the amount of capital employed. On that you have to apply weighted average cost of capital. But the question is, weighted average cost of capital is not given to you directly. You will have to determine weighted average cost of capital. The question is, how would you determine weighted average cost of capital? To compute that, first thing what you have to do is compute cost of debt, compute cost of equity. That means for each component of your capital employed, you have to compute the respective cost. Now at intermediate level, you have very clearly learnt how to compute this cost of debt and cost of equity. You have also learned how to compute weighted average cost of capital. So what we generally do is, keep in your mind one thing: when you compute cost of debt, it is again the post-tax effect. So the post-tax interest amount is basically already computed as 350. It is 350 divided by 5000 would give you the post-tax cost of debt. In percentage, if you want, you just multiply by 100. So it will be 350 divided by 5000 into 100, and I'm sure you would be getting that as 7%. Next thing what you will do is, using capital asset pricing model that you have been learning throughout right from portfolio topic, use capital asset pricing model and apply CAPM equation, that is RF plus RM minus RF into beta, and you would easily get cost of equity, because in this question cost of equity was supposed to be determined by CAPM. Now one more thing, at intermediate level you have learned determining cost of equity by different methods. Here you will be determining cost of equity by just one singular approach most of the times, and that will be capital asset pricing model, because capital asset pricing model is the focus point at your level. Now for computing KD, just apply this particular formula, that is interest into 1 minus tax rate divided by net proceeds. If you have used short forms, do mention the elaborate form of these, and when you make the computation, the cost of debt would work out to 0.07 or 7%. Now apply CAPM and compute cost of equity, which will be basically expected rate of return as per CAPM. So it will be 8% as risk-free rate, 16% as market returns, and beta factor is 1.5 times. So what you simply do is 8 plus 16 minus 8 into 1.5, which would give you 20%. So now you have to just compute the weighted average cost of capital. And do you know how to compute the weighted average cost of capital? Computing weighted average cost of capital, just a simple way. You make a table where you start with share capital, reserves and debentures as the three sources of your capital. Write down the amount of each of these. In the K column, you mention the cost of capital for each individual component, and be careful over here, for the reserves the cost will be same as cost of equity. So for reserves you just apply same as cost of equity, that is 20%, and in the last cost column what we are doing is we are applying these percentages on the book value amounts to arrive at the exact cost by monetary value. When you take the total of the amounts of capital, it comes to 10,000. It was already given in the balance sheet. When you take the total of cost, it comes to 1,350. So your weighted average cost of capital will simply be total cost of capital divided by total amount of capital, which will be 0.135 or 13.5%. I want all of you to take note of this, and then we shall move ahead. After computing weighted average cost of capital, what you just need to do is move ahead and apply this equation now. EVA is net operating profit after tax minus multiplication of weighted average cost of capital into capital employed, and that will be 1750 minus 1350. So basically your capital charge is 1350, which was the total of that cost column, and 1750 is the net operating profit after tax. So your final answer of EVA comes to rupees 400. Alright friends, once you have completed this entire solution, let us move ahead and take up the next question. That will be question 5B, and that will be question number 9 from your textbook from the chapter Mergers and Acquisitions. So let us deal with this as well. K Limited is considering acquiring N Limited. The following information is available. So they have given information about both the companies K and N Limited, both the companies' profit after tax, number of equity shares and market value per share given. Exchange of equity shares for acquisition is based on current market value as above. There is no synergy advantage available. Find the earnings per share of K Limited after merger, that is simply post merger EPS, and find the exchange ratio so that shareholders of N Limited would not be at a loss of earnings. So friends, now it's like repeatedly similar type of questions coming up. You very well know how to deal with these situations. So what you would do, simply first work out the post merger EPS, and you know one thing, that if the shareholders of target company are not to suffer with loss of earnings, we would recommend that the exchange ratio should not be based on market price per share but should be based on EPS. So that part will come later. Let us first compute the post merger EPS, and for that we have to first arrive at the swap ratio based on market price, and that will be 160 by 200, that is 4 by 5, and you would simply write 4 shares of K Limited shall be offered to shareholders of N Limited for every 5 shares in N Limited. So do one thing, write up this thing quickly and then we shall move ahead. Alright friends, you would have finished writing this much. Let us move ahead, and now what we do is we find out the number of shares to be issued, and you know it very well. It is the number of shares in target company, that is N Limited, multiplied by swap ratio. So that will be 2,50,000 shares into 4 by 5, resulting into 2 lakh shares. Post merger total earnings, it will be simply the aggregate of earnings of both the companies pre-merger, and there are no synergy advantages, so aggregate earnings would be 65 lakhs, and that will be considered as post merger total earnings. We also work out the post merger total number of shares, that will be 10 lakh plus 2 lakh, that is 12 lakh shares after the merger. So write up this much and then we shall move ahead. Alright friends, let us move ahead and now determine the post merger EPS. What is the main requirement of the question? And post merger EPS will be simply post merger total earnings divided by post merger total number of shares. That will be rupees 65 lakhs divided by 12 lakh shares, and that comes to 5.4167 per share. Now the question has also asked what should be the swap ratio so that the shareholders of target company, that is N Limited, should not suffer loss of earnings. So we will recommend that in that case the swap ratio should be based on EPS instead of MPPS. So we are going to show that swap ratio and its effect, but first what you do is write up whatever you find on screen quickly. Alright friends, let us move ahead, and now what we do is we would work out the current EPS of both the companies, that is rupees 5 per share for K Limited and rupees 6 per share for N Limited. The revised swap ratio will be the EPS based swap ratio, that will be 6 by 5, and that is 1.2. In that case the number of shares to be issued by K Limited to N Limited, or in other words shareholders of N Limited, would be the existing number of shares of N multiplied by the swap ratio, and that will be 3 lakh shares. So quickly write this as well. Alright friends, after writing this, let us move ahead and make the last calculations. So the total number of shares of K Limited after acquisition this time will be 13 lakh shares, and post merger EPS this time will be 65 lakh divided by 13 lakh shares, and that will be rupees 5 per share. Total earnings in K Limited for shareholders of N Limited will be rupees 15 lakhs. Now this is equal to the earnings of N Limited prior merger. Therefore exchange ratio should be based on EPS, and that is what is recommended so that the shareholders of target company N Limited do not suffer with loss of their earnings. So quickly take note of this whole thing, and that will be end of the solution. Alright friends, once you have completed writing this solution, let us move ahead and deal with the next question, and that will be question 5C, which from your textbook it is question number 7 from the topic bond valuation, and let us deal with this. So this is supposed to be the last question for our discussion. Face value of the bond rupees 1000, coupon rate 9%, coupon payments are made at end of each year, remaining maturity is 4 years. Bond is redeemable at 15% premium. Present market price of the bond is rupees 820 for the principal strip and rupees 260 for the interest strip. If the desired rate of return for the investor is 11% per annum, determine whether the bond strips are overpriced or underpriced in the open market. Now friends, this is going to be very simple. You just have to find the present value of future cash flows. Instead of taking the aggregate of the two, you may individually compare the present value of interest strip and principal strip with their respective market prices. So let us see how to present the solution. You would simply work out the present values of the cash flows exactly the same way as we work out the intrinsic value of any ordinary bond. So you will find that the present value of interest strip came to 279.22 and the present value of the principal strip is 757.54. When you take aggregate of these two, you get the entire value of bond. But if you would want to evaluate the strips of both the bonds, whether they are underpriced or overpriced, you would simply make up an additional table. Interest strip and principal strip, intrinsic value what we have determined above, see 279.22 from this part of the table, 757.54 from this part of the table, and finally when you have noted down the intrinsic values, you may simply also write up the quoted market price with respect to each of them, and then you find that the interest strip is underpriced and the principal strip is overpriced. So let us do one thing. Let us first write up this whole solution and then we talk ahead.